Imagine a casino where the bets are worth more than all the money on earth, where you're gambling on things that don't exist, where a single bet can destroy a country's economy. This isn't imagination. This is the derivatives market, and it's 10 times bigger than the entire global economy. In 2008, this invisible market nearly collapsed civilization. Banks failed, governments panicked, millions lost their homes, and most people still don't understand what actually happened. Here's the thing that keeps me up at night. The derivatives market is now bigger than it was before the crash. Way bigger. We're talking $600 trillion. That's more than all the stocks, all the bonds, all the real estate, all the actual money that exists in the world combined. And you can't touch any of it. You can't see it. You can't own it. It doesn't physically exist. So what exactly is a derivative? Let me show you how this invisible empire was built. Let's start simple. Imagine you're a farmer. You plant wheat, but you won't harvest it for 6 months. You're worried. What if wheat prices crash by harvest time? You could lose everything. So you make a deal with a bakery. You promise to sell them your wheat in 6 months for today's price. They agree. Now you're protected. If prices fall, you're safe. If prices rise, the bakery's protected. This deal, this promise about future wheat, is a derivative. It derives its value from something else. In this case, wheat. That's actually useful. That's insurance. That makes sense. But here's where it gets weird. That promise, that contract, can be sold. The bakery can sell your wheat promise to someone else. That person can sell it to another person, and another, and another. Now there are 10 people trading promises about your wheat, then 100, then 1,000. Pretty soon, there are more promises being traded than actual wheat that exists. Welcome to the derivatives market. In 1980, the derivatives market barely existed. A few farmers, a few commodity traders, maybe a few $1 billion total. By 2000, it had grown to $100 trillion. By 2008, it hit $600 trillion. Today, it's estimated at over $1 quadrillion in notional value. How did we get here? How did promises become bigger than reality? The answer starts in the 1970s. Before then, exchange rates were fixed. Interest rates were regulated. Prices were stable. There wasn't much to bet on. Then everything changed. Exchange rates started floating. Interest rates became volatile. Oil prices spiked. Suddenly, the future became unpredictable. And where there's uncertainty, there's opportunity. Banks saw this. They started creating new kinds of derivatives. Interest rate swaps, currency futures, options on everything. They weren't just helping farmers anymore. They were creating financial weapons. Here's the magic trick they discovered. If you can predict the future better than other people, you can make unlimited money. And if you can't predict it, you can make it look like you can. Remember that farmer's wheat contract? Banks turned that simple idea into something infinitely complex. They bundled thousands of mortgages together. They sliced them into pieces. They created derivatives of derivatives of derivatives. And here's the brilliant part. They convinced everyone these were safe. They got rating agencies to call them AAA. They got regulators to look the other way. They got pension funds and insurance companies to buy billions of dollars worth. But nobody actually understood what they were buying. Not really, because the math was so complex that only a handful of physicists and mathematicians could follow it. And even they didn't see the whole picture. By 2007, the derivatives market had become a tower of promises, built on promises, built on promises. And somewhere at the bottom, buried under trillions of dollars of bets, were actual things. Houses, loans, people who just wanted to own a home. Then the tower started to wobble. It began quietly. A few people in Florida stopped paying their mortgages. Then a few more in California. Then thousands across America. These were subprime mortgages. Loans given to people who couldn't really afford them. Normally, a few thousand bad loans wouldn't matter. Banks could absorb that loss. But remember, these weren't just loans anymore. They were the foundation of a trillion-dollar derivatives tower. Every mortgage had been bundled. Every bundle had been sliced. Every slice had been bet on, and bet on again, and again. So when those mortgages failed, it didn't just hurt one bank. It triggered a chain reaction through the entire derivatives market. Here's what made it catastrophic. Nobody knew who owned what. Bank A had sold derivatives to Bank B. Bank B had sold them to Bank C. Bank C had sold them to a pension fund. The pension fund had sold them to an insurance company. And that insurance company had sold them back to Bank A. It was a circular firing squad. Everyone was pointing guns at everyone else, and nobody knew who would shoot first. In March 2008, Bear Stearns collapsed. In September, Lehman Brothers fell. AIG, one of the world's largest insurance companies, needed $180 billion to survive. Why? Because they had sold derivatives promising to cover losses they couldn't possibly pay. The financial system froze. Banks stopped lending to each other. Why? Because they didn't know which banks were holding toxic derivatives. Trust evaporated overnight. Governments had a choice. Let the banks fail and watch the economy collapse, or bail them out with taxpayer money. They chose the bailout. Trillions of dollars. Your money, my money, used to save banks that had gambled and lost. But here's what nobody talks about. The derivatives market never really got fixed. It got bigger. After 2008, regulators tried to add rules. They created clearinghouses. They demanded more transparency. They banned some of the worst products. But the fundamental problem remained. The derivatives market is still based on promises about the future, and the future is unknowable. Today, 5 banks control most of the global derivatives market: JP Morgan Chase, Goldman Sachs, Bank of America, Citigroup, Morgan Stanley. Together, they hold over $200 trillion in derivatives exposure. Think about that. 5 institutions, more exposure than all the money that exists. What are they betting on now? Everything. Interest rates, exchange rates, stock prices, commodity prices, credit defaults, even weather patterns. There are derivatives on whether companies will go bankrupt, derivatives on whether countries will default on their debt, derivatives on whether other derivatives will pay out. It's gambling disguised as risk management, and the house always wins until it doesn't. Here's the invisible danger. Most derivatives are traded privately, not on public exchanges, in private deals between banks. This is called the over-the-counter market, which means nobody, not even regulators, knows the full picture. Nobody can see all the connections. Nobody understands the total risk. It's like playing poker where you can't see anyone's cards, including your own. And there's another problem. Derivatives are leveraged. You can control $1 million worth of derivatives with just $10,000. That's 100-to-1 leverage, which means small price movements create massive gains or catastrophic losses. In 2012, JP Morgan lost $6 billion on derivative bets made by a single trader in London. They called him the London Whale. One person, $6 billion, gone. In 2021, a family office called Archegos collapsed. Their derivatives bets went wrong. They lost $10 billion in 2 days. Banks who lent them money lost another $10 billion. These aren't rare events, they're regular occurrences. We just don't hear about most of them, because banks don't like to admit when they're wrong. The scary part? These are the failures we know about. How many close calls happen that never make the news? How many banks are one bad bet away from collapse? So here's the question nobody wants to answer. Why do we allow this? The usual explanation is that derivatives serve a useful purpose. They help companies hedge risk. Airlines lock in fuel prices. Importers protect against currency swings. Farmers secure crop values. And that's true for maybe 5% of the derivatives market. The rest, pure speculation. Bets on bets on bets. The real reason derivatives exist at this scale is simpler. They're profitable, incredibly profitable. Every derivative trade generates fees. And when you're trading $600 trillion worth of derivatives, even tiny fees add up to billions. Banks have an incentive to make derivatives complex because complexity creates information asymmetry. They understand the products. Their clients don't. That gap is where profit lives. And there's another uncomfortable truth. Derivatives allow banks to hide risk. They can move losses off their balance sheets. They can make bad investments appear safe. They can gamble with other people's money while paying themselves massive bonuses. When bets pay off, bankers get rich. When bets fail, taxpayers bail them out. It's a system designed to privatize profits and socialize losses. Here's what keeps regulators up at night. The derivatives market is interconnected globally. A failure in Tokyo can trigger a crisis in New York. A default in London can collapse a bank in Singapore. We've created a financial weapon of mass destruction. Warren Buffett called it that back in 2003. He was right then. He's even more right now. And unlike nuclear weapons, which countries try to limit, the derivatives market keeps growing because there's no global authority that can stop it. Financial regulation is national, but derivatives are international. So what happens next? Three possibilities. First possibility, nothing. The derivatives market keeps growing, banks keep making money, and we get lucky. No major crisis for another decade, maybe two. Second possibility, another crash, bigger than 2008, because the derivatives tower is taller now, more complex, more fragile, and when it falls, governments might not be able to bail everyone out. Third possibility, slow reform. Countries start coordinating. They force derivatives onto public exchanges. They limit leverage. They make banks hold more capital. They separate gambling from banking. Which future we get depends on whether we understand the system before it breaks again. Because here's the final truth. The derivatives market isn't natural. It's not inevitable. It's a choice made by banks, enabled by regulators, allowed by governments. We built this system. We can change it. But only if we first understand what it really is. Not sophisticated risk management, not financial innovation, not a necessary part of modern capitalism. It's a $600 trillion casino where banks bet with your money, where profits go to a few, where losses fall on everyone. And the scariest part? Most of the world still doesn't know it exists. Now you do. And maybe that's where change begins. With understanding, with asking questions, with demanding that the people who control these systems actually explain them. Because an invisible empire only stays powerful as long as it stays invisible. The moment we see it clearly, we can decide if this is really the financial system we want. If this changed how you see money, hit subscribe. Next video, I'm breaking down another invisible system that shapes your life. The Global Tax Haven Network. Trust me, you won't believe where your money actually goes. See you there.